Hey, everybody, welcome to our year-end tax planning seminar today. Is my audio sounding okay? Everybody here? Anybody having trouble hearing me?
Okay. I hear you good.
Okay. So 2020 has been a weird year for a lot of stuff for everybody, as we all know, and it's a weird year for tax planning too. There's a lot to think about this year that's outside the ordinary, and we're going to try to get together and talk about some of the things we need to talk about this year, some of which are the normal things we talk about, and some of them are a little different this year.
Yeah, I would say that in my 40 years of tax seasons that I've incurred, this is probably the strangest one that we had was this last year. Not due just only to the staff working from home, less clients coming in, but also due to the extended due dates, the extended options on your payments, everything else that was COVID related. So it was off. This last year was a strange year. Not for sure this next year will be all that much less strange.
Yeah, we've got obviously the economy has been kind of a mess and businesses are having some trouble. People are getting laid off. Stock market it tanked, and then the stock market's been spectacular. We've got some law changes, some of which are permanent, some of which are temporary. And so just all of these different things that are going on are kind of overlaid onto the normal planning that you have to do at year end. So what's the right answer for different people is going to be complete opposite as what's the right answer for others. And so so then the other thing that goes into it is just with the election, what are we going to be looking at for next year's tax rules? We know what they are this year. We don't know what they are next year. What are you hearing, Craig?
Yeah, that just makes it really difficult with regards to planning for next year. And what we're typically doing is pushing income, into the next year and trying to bring deductions into this year is one of the typical planning points that you're doing. Makes it a little more difficult, not knowing what next year's tax rates are necessarily going to be. Biden has made several proposals. He had that in his campaign. Right now, based on where the wind is in Congress, it's hard to know exactly which of those, if any of those, are going to take traction and get passed. And if they get passed, will it be late in the year? And if so, will they be retroactive back to January 1, or will they be effective for 1/1/2022 perhaps? So it makes tax planning a little more difficult, not knowing what next year is going to look like.
Yeah, you talked about raising the maximum tax bracket for upper income people to 39.6% from the current 37. Talked about turning capital gains into the same rate as ordinary income. The 39.6 kind of puts us back to where we were a couple of years ago. That's not as drastic, but capital gain becoming the same as ordinary would be a complete shift in thinking. And so now that said, some of that is things you say on the campaign trail. Biden's historically been fairly centrist on things. Some of that is things that might have been said when they thought there was going to be a little bigger Democratic mandate, and now that it looks like there's not, there's the practicalities of getting legislation through and negotiating. And so I think a lot of people are thinking that some of the things that were said early on the campaign trail may not come to pass, or if nothing else, may not be first on the agenda when Congress convenes. There's a lot of stuff dealing with the virus and some other things that may be higher priorities than tax policy. So all that said, we still have to figure out what to do, not knowing what legislation we're going to have. So, but just one more consideration to throw into this mix that we're working with.
A few other things that Biden proposed was that we'd see corporate tax rates raised from that flat 21% that we went to in 18, up to 25, maybe 28%. We had some changes in perhaps estate taxes as well that we'll address a little bit later in the seminar. But The biggest thing is a elimination of the step up in basis rules that we've had for a very, very long time that has benefited lots and lots of folks, both rich and poor, perhaps in some instances. So it's not just the rich man's that's going to be impacted by if that were to pass. But that does make the planning a little more difficult. But we're going to do the best we can with what we've got.
Yeah. So that said, some of the planning revolves around some of the new rules that they put in this year dealing with COVID relief. One of the biggest things that is that people are talking about is the required minimum distributions on IRAs and qualified plans. Normally, well, there's two sets of rules that came on. One is last December, the date for having to, the age for having to start your required minimum distributions for your retirement plans changed from 70 and a half to 72. So if you didn't turn 70 and a half by December 31st of 19, you're under the new rules with age 72 as the beginning of your RMD. Then in March with the COVID relief package, one of the things they put in was that you didn't have to take your required minimum distribution for 2020. And so if you don't really need it for your retirement income, then there is, at first blush, you say, well, gee, I'll just leave that in the IRA and let it build up and not pay tax on it this year. And that's the right answer for some people. But one of the things that happens is, if you are retired and a good bit of your retirement income comes from the RMD, let's say you've got just a few $1,000s of interest in dividends, you got a lot of Social Security and a great big IRA rollover. If you don't take your RMD this year, and you just have a little bit of investment income, then your Social Security is also not taxable. And so you have zero tax. You could increase your income and still have zero tax. And so for a lot of people, it makes sense, if you're in that situation, to maybe not take the full RMD, but take an amount that gets you up to where you get up to maybe having a tiny bit of tax, but where you use up all of your standard deduction or your itemized deductions, and you're able to pull money out of your IRA tax-free. So you may not want to pay a bunch of tax like you might normally with your IRA RMD, but you probably should at least consider taking out enough to get all of your tax-free IRA money out.
And in some instances, you may want to use up to 10 to 12% tax brackets. I've even got a couple that we're using up to 22 and 24% tax brackets because it's always going to be taxed at higher than that. Let's get it out, even though it's not zero taxed. Let's get it taxed at those lower rates. And so, and many times we're even having the folks look at doing some Roth conversions, taking that IRA. You can't take an RMD and convert it. This year, there is no RMD, so we can do a conversion. And so we're looking at converting some of the IRA monies to Roths to use up that 0%, that 10%, that 12%, and in some cases, 22 and 24% tax brackets. There's a lot of moving parts to it. I mean, once you have that taxable income, it does create more of your Social Security being taxed. And so that real tax rate maybe is a little higher than 22% because you're making more Social Security be taxed. Also, perhaps if you have capital gain or qualified dividends, which would be zero taxed or 10 or 15, it may raise those up into a little higher tax rate as well. So you have to do quite a bit of planning and have to make some runs and projections to see what is the best level of conversion.
Yeah, and the other thing that a lot of times people forget about too, there's a number of stealth taxes that are out there in the code and in the system. But if your income goes above a certain level, your Medicare premiums go up. Exactly. And if it goes up above another level, it goes up again. And so while that's not a tax increase, additional income causes you to pay more Medicare tax. So it's a lot like a tax increase. And so you got to watch out for that as well.
And that's just not for one taxpayer. That's if you're married filing joint, you're both on Medicare. If it's a $100 a month increase going from one level to the next, now it's a $200 increase, 100 for each of you. And so that's, $2,400 for the year.
Yeah. And it can be a good sized number. The RMD rules were suspended for the year. If you took the RMD, you were allowed to put it back in, put your RMD back into the plan by August. And so if you did that, great. If you didn't do it by August, that has passed. It is still possible to, in some situations, maybe get it back in. If you took a distribution out of your IRA and you've got 60 days to put it back in, so that's a possibility. The other thing is if you took distribution out of your IRA or 401k, and you had COVID issues, you had, your business took a hit, or if you weren't working for a while because of COVID, or you had medical bills because of COVID, or basically negative financial impacts of the COVID pandemic, you actually have up to 3 years to get it back into the plan and not pay tax on it. So you can still put that back in the plan this year if you've got some of the COVID issues. And so that is also a possibility. So we have with the RMDs, we have some people that need to not take it this year, others that need to take it, some people that need to take part of it. We've got kind of the same thing going with capital gains. It's a weird year in the stock market. Things just tanked about as bad as you've seen them tank for probably 4 to 5 weeks in February and March. And then they went back the other way just about as hard, went right on past that and have continued on up. And this has actually been a banner year in the stock market. That said, if you got out in March, you might be at a big loss for the year. It may be that you didn't get in until January, or excuse me, you didn't get in until March or April, and you had a huge year. So and then there's individual companies who've done really poorly anyway, even with the market going up, because the airline stocks have kind of got beaten around. There's a number of different kind of investments that have done poorly, while others have, you may have huge gains. Amazon, Tesla, some of those things have really gone crazy. So that said, if you've got gains in your portfolio, you really want to look at harvesting losses that you might have there. If you've got unrealized positions that have losses in them, it may be worth looking at selling some of those to shelter some of the other gains that you may have. And then like we talked about with the RMD planning, the other side may be true as well. If you didn't take your RMDs this year, if your income's, or maybe your income is down because your business did poorly this year with COVID, or you were unemployed. So maybe this is a low income year. You may want to actually go out and recognize some capital gains. The tax rate on long-term capital gains for a couple with taxable income below $80,000 is zero. If you've got $100,000 worth of income, mostly from $100,000 of income, and you've got, let's say, $40,000 worth of deductions, so you're only at 60, you could add another $20,000 of long-term capital gains and pay zero tax. So there's a lot of situations where you may do well just to go out and actually recognize some built-in gains, even though that's kind of contrary to your normal thinking. There are situations where it makes a lot of sense. Even if it's a stock you don't really want to get out of, you can sell it, buy it right back, and you've reset your basis to where it'll be less gain to recognize in the future.
Now,
Also, yeah.
typically the discussion, we are harvesting losses to offset capital gains. This may be a year where we may end up trying to harvest some gains to offset some of the capital losses you might have had in a prior year. I just looked at one earlier today and responded back to the financial advisor. Let's see if we can harvest any gains to offset some of these losses that we had earlier in the year. Because it will be zero tax perhaps. So
yeah, and situations though where your business is down, normally your business makes a couple hundred a year. This year it broke even. It may be a year you want to go out and recognize gains and get it, some of that 0%, even where you don't have capital losses sheltering them, you're recognizing them at a 0% tax rate up to a point. The other thing to look at, and this is true every year, but more so this year, if you have an investment that has become worthless, you are allowed to write that off as a worthless stock deduction in the year it becomes worthless. And so, economy being what it is, there may be more of those than normal this year. The other thing, if you've made loans to people, loans to businesses, loans to entities, if the loan is worthless, you're allowed to take a short-term capital loss for a non-business bad debt, and that may be worth looking at this year too. It may be that if people in worse financial situations, it may become clear that you're not going to get a loan back that you made. And so writing those off can help shelter gains that you might have in the market. And then the last thing is, in seminars in the past, we've talked about qualified opportunity zones. These, if you have capital gains that you've recognized and you invest in an investment in a qualified opportunity zone, you can defer that capital gain, not pay tax on it. Over the next 7 or 8 years, the 15% of that gain is permanently forgiven. And then all the gain that you have from this point through, I believe it's 10 years, is also then forgiven going forward. And so while those are sometimes hard to set up on your own, you can do it, but they're hard to set up on your own. There are some funds out there available through some of the investment houses where you invest in a fund of qualified opportunity zone properties. And so that may be something that somebody with a big gain might want to look at doing.
I talked with a few folks on that, and those have not gained in popularity, have not become as popular as we thought they probably would have when they first came out. They've not been out all that long. The upside is you get some deferral on your actual gain that you have now. If you keep it 5 years or 7 years, you get a 10 and a 5% up to 15% reduction of that original gain. And then as Brian said, the actual gain on the investment itself, if you put $100,000 into it and it grows to be 150, you keep it for 10 years, and that $50,000 gain is excluded from taxation. The downside is of these funds are that most of them that we're seeing are in the larger cities, and we haven't started seeing many in the smaller cities. I expect that we will have some in Waco. We do have some opportunity designated zones, and so I think we'll have some. There may be some out there that I'm not aware of, but where you can at least drive by and see your investment, as opposed to being in New York City or Florida or Arizona, where a lot of them are. And we also see that sometimes the folks that are putting these together, that they may be, the cost may be running a little high. And so you want to look at everything, what your potential gain might be there, and potential appreciation in your actual investment. And you are tying it up for a pretty long time.
Yeah, the fees that the managers in these funds charge tend to be higher than like in a mutual fund or a managed account, and in some cases a whole lot higher. So you want to be careful of what funds you are looking at getting into to be sure that the fees justify the tax savings that are involved. So Another provision that came in the CARES Act with the COVID relief relates to net operating losses. So many businesses were struggling, and that they changed the rules on when you have business losses. In the past, you could carry losses back and forward. In the 2017 targeted jobs, the targeted TCJ,
CJC.
TJCA, in 2017, they got rid of net operating loss carrybacks and said you could only carry them forward to future years and only offset 80% of your income in any given year. So in March of this year, they changed that to go back to even more generous rules than we had before. We under the prior regime, we had a 2-year carryback period that you could look at. Now it's a 5-year carryback period. What makes it even more complicated is that you can also carry back 2019 and 2018 losses. So it's potentially you would amend your 18 and 19 years to carry those losses back to earlier years. You could carry back a 2020 loss to prior years. And it makes for some complicated planning. You're allowed to waive that carryback period. You're allowed to say, okay, I don't want to carry it back. I just want to carry it forward, which you might do if maybe the tax rate's not very high in the earlier years. A lot of times you end up carrying back to an earlier year for almost zero tax benefit. And so you don't want to waste your loss that way. And so you can waive your carryback period. You might choose to waive your carryback period on your 2018 loss. It would carry back to 2013, but actually carry back your 2019 loss to 2014 or your 2020 loss to 15, so that you can kind of mix and match, carry back some years and forward others. So there's a lot of complicated calculations to go through that involve your tax returns for the years from 2013 all the way to 2020, and looking at whether or not you want to take advantage of these carryback periods. If you're going to waive those carryback periods, you've got to do it by the filing of the by the date of the filing of your 2020 tax return. The other thing, so if let's say you've got a business that's done poorly this year, and so you've got a big loss, and you say, okay, well, I don't need to do any planning because I've already had I'm already at zero and I've got a big loss. Well, that may or may not be true, that with these loss carryback provisions going back to 2013, 14, and 15, well, actually all the years from 2013 through 19, you may want to increase your loss even further. So you get a bigger carryback to prior years so that you get a bigger tax refund. And so planning may be important even if you clearly don't have tax this year.
You may find that even if you're in the 37% tax bracket this year and might expect to be in that next year as well, your carryback years back to 13, 14, 15, you could have been in 39.6%. So you're getting some really great savings by carrying those back. Typically on the carrybacks of these NOLs, you either do them on either an 1120X or a 1040X. But there's these quick refund forms that are the 1045s and 1139s, 1045 for individual, 1139 for corporations, that you can, if it's just NOL, you can use those forms to do it. You get, IRS is supposed to process those quicker, and IRS is not processing anything very quick right now, but they even allowed and set up special fax lines for us to use those. That's only available for 19. 18, they made a special rule where you could do it up until, I think, July the 15th. But that's passed now. So that has to be done on either a 1040X or a 1120X if it's a corporation to carry those back. But those for 19, the 19 losses, you have until December 31st this year. So we're gonna have to get those done in a hurry. And you can then fax it to the IRS for quicker processing of getting that refund.
Yeah, no, the December 31 is the due date to use the Form 1045 or 1139 that are the quick refunds. If you go past that, you can still carry your loss back, but you just have to do it on an amended return, and those take a whole lot longer to process. But you haven't lost the ability to carry it back. You've just lost the ability to get it refunded quite as quickly.
To do a quick one.
Right.
You know, my experience, I don't know what Brian's is, but the amended returns now are taking forever for the IRS to go through and process those. So it may be 6, 9 months, 12 months, before you get your refund back, but at least you get it back.
Right. Yeah, and they do bear interest after 45 days, so there's at least that. So, and they are paying 3% interest, which is better than you get anywhere else these days. Depreciation rules enter into this. When you're looking at how much you want to carry back, how big do you want your loss to be this year? The depreciation rules give you a lot of flexibility in figuring out precisely what you want that loss to be. You can expense things with 179 expense, with bonus depreciation. You can pick different levels of expensing. So it does give you a lot of power to fine tune your loss to, a more precise number. And so you want to be looking at all the assets that you placed in service in 20 to get the precise level of loss that you want, but also in 19 and 18. There are possibly opportunities to change your depreciation in those years, and to change the depreciation on a return that's already been filed. There were some back in the 2017 law change, there were some changes in depreciation, and they did a poor job of drafting. And so the way they wrote the law, building improvements, restaurant property, a lot of these things that they were expecting to be able to be written off, turned into 39-year depreciable property. They went from being the best possible depreciation answer to the worst possible depreciation answer. They fixed that in the CARES Act in March, retroactive to December of 17. And so you've got the opportunity to either amend your 17, 18, 19 returns, your 17 and 18 returns to claim the depreciation you should have been entitled to then, or you can make an accounting method change on your 19 or 20 tax returns and just pick up the cumulative effect of that additional depreciation in this year's return. So there are, if you claim the depreciation in 17 or 18, you're talking about carrying it back. If you do it in 17, you're talking about carrying it back to 2015. If you do it in 18, you're talking about carrying it to 2013 if you generate a loss, 19, 2014, and so forth. So there's a lot of thinking in those, in how you might choose to change your tax returns for the law change this year for improvement property. And that's basically just about anything in a building, in the interior of a building, other than elevators and other than things that enlarge the building. But just about any sort of leasehold improvements, any sort of other freshening up you did, HVAC, all those sorts of things qualify for this improvement property and to be written off in the year you put it in service. And so very valuable provision.
Back in 18, when this happened, and they basically just poorly drafted the wording so that it got excluded when it was certainly meant to be included. We kept holding off the filing of the returns in 18 for those folks that have non-residential property that had made improvements during that year, thinking they're going to correct it, they're going to correct it, they're going to correct it. And IRS had come out and said, unless it gets corrected, we're taking the position it's 39-year property. And so many of those, we waited till the last minute, finally filed those returns. And then they have now corrected it and made it retroactive, as Brian said. And so, I mean, this is the year of amended returns. Apparently, with the NOL, the big change in the NOLs being allowed, with this change of your qualified leasehold improvements being allowed, you have a lot of opportunity to go back and amend returns and get some deductions that weren't allowed at that time, and then carrying those back if it creates losses to get monies back in those prior years.
Another deal that affects a lot of small businesses and a lot of how much your loss might be in 2020 relates to PPP loans that businesses have gotten. These were the SBA loans that you got based on the payroll that you had in the previous year. And if you spent the money on payroll, rent, and utilities in 2020, during a specified period, then you got your loan forgiven. When Congress enacted that, they said that loan forgiveness will be tax-free, which sounded great, and it is tax-free. The problem is, in order to get it forgiven, you had to spend it on these certain things, and if you didn't spend it, it wasn't forgiven. If you did spend it, it was. There's a code provision that Congress really didn't think all the way through that says you can't deduct expenses attributable to producing tax-exempt income. And so while the way the law reads, while the PPP forgiveness is tax-free, that makes an equal amount of payroll taxes, benefits, utilities that you pay to get it forgiven non-deductible. So even though it's tax-free, you have an equal amount of non-deductible expenses now, and it's the same net effect as it being fully taxable. Congress at the time said, gee, that's not what we meant at all. The IRS had come out a month or two after the law came out and said they believe that these expenses would be non-deductible. Congress says that's not what we meant. We'll get that fixed. And like everything in Congress these days, they have a hard time coming together to agree on something. And so this has languished all year long, and the rule has not been changed. Now there's a bill, another stimulus bill working its way through Congress that they're trying to hash out some compromises. And that bill has very little in it related to taxes, other than it does have language that says these expenses related to the PPP forgiveness will be deductible. So that's a good thing. It looks like the bill is moving forward. It's getting closer to compromise. John Cornyn on the Senate side has been very actively promoting, getting this fixed. He says that there's not much opposition to it. Everybody meant for it to be tax-free income and deductible expenses. So it sounds like we're finally getting a little momentum to make that change and to fix that problem. Let's hope that that's the case. It makes it hard to plan right now. You know, if you've got a $300,000 PPP loan and you spent 300 grand to get it forgiven, you don't really know what your income is by a pretty wide margin right now. And so it's kind of hard to plan on what to do. But at this point, it looks like there really is momentum to get that fixed. And so we, hopefully they'll do it quickly over the next, couple weeks. Maybe we'll get some clarity on whether or not this is really going to happen. Trump has sent a bill that he wants them to pass for the relief. So clearly they're all talking about something that would be signed by Trump. And so that would be, you would think that means that they're talking about pushing this through here at year end. And so we may at least have some clarity within the next 2-3 weeks. We can hope.
That's exceptionally good news if this were to occur. I mean, up until just last week, IRS had they'd drawn a line in the sand basically and said it's going to be that expenses are non-deductible. And so we then thought, okay, was there a way to push them from 2020 to 2021 by delaying the forgiveness until 2021? They came back out and said, nope, it's in the year in which they were incurred. If there's a high expectation the loan is going to be forgiven, then the non-deductibility is going to be in the year in which it incurred, which makes it 2020. And so, we've been telling folks that it looks like it's going to be a taxable event, basically, and the taxes are going to be paid on it. So let's hope the wind continues to blow in this right direction, and we get a remedy on that. And indeed, the PPP loan forgiveness is not a taxable event. I had to remind clients over the last several months that even if it's taxable, it was still a pretty good deal. I mean, even if you're in a 21% C corporation, 21% tax bracket, it's still a 79% gift that helped you during tough times. But we were all expecting it not to be taxable when it first came out. That's certainly what Congress told us, and that's what we were expecting. And so let's hope that something gets passed, and that it gets passed before we're having to file returns for the 2020 year, because we're going to be on the fence if nothing's passed at that time as to how to handle it.
Right. So another thing to keep in mind as we do planning, a lot of businesses have losses this year. We're looking at the planning related to that. Maybe we have a NOL carryback, net operating loss carryback, and all that's great. A lot of people operate as S corporations, and S corporations that pass through losses those are typically deductible in the shareholders' personal returns, but they can't exceed your tax basis in your stock. So if you have a great big loss this year that's attributable to an S corporation, and maybe that loss got funded with a bank loan or let's say a PPP loan, and it happened at the shareholder level, at the company level, the shareholder doesn't get basis for that outside debt. And so you want to be sure that you have enough tax basis to deduct your loss. It may be that you need to add some capital to the corporation to get additional basis. It may be that you could rearrange your loan to be a personal loan from the bank to you and a loan by you to the corporation then, because you do get tax basis for that. So it's possible to rearrange the financing to make it where it works. But if you just have, if you've put up 50,000 in a business and borrowed $500,000 at the bank in an S corporation, if you've put in 50,000 into your S corporation, the S corporation borrowed $500,000 at the bank, and we have a $150,000 loss this year, you can only deduct the 50,000 of basis that you have. You can't deduct the part that got funded by third-party debt. So it's something you want to look through carefully if you have a big loss in an S corporation this year, and make sure that you've got enough basis to deduct this, that you don't just assume I'm going to deduct this whole thing and then find that you have limitations on the amount of the loss that you can take.
Brian, apparently IRS has thought that there's been a little abuse in this. Not everybody was limiting those losses to their at-risk basis, because they've come out now and now with the tax return, if the S corporation has distributions, loan paybacks, and or losses, then a schedule is going to have to be completed and be part of the return that proves that you had basis to deduct those losses, that those distributions did not create income. And so apparently they felt like there was a little abuse going on in that area, and people were deducting the losses whether or not they had basis or not when they got their K-1 from the S corporation. But that's going to be a thing of the past, because we're going to have to actually attach the a worksheet, confirming in fact that there was sufficient basis to deduct the loss.
Mm-hmm. Yeah, and they're also requiring some partnership basis schedules as well. And so if these are things that, if you had an S corporation around for a long time,
Mhm.
it's a little bit of a pain to go back and try to recreate what your basis actually is. But we've done that on a lot of clients this last year or so. And some of them, it's a little bit of trouble to figure out what it is. Others are easier, but it depends on the entity. But that's something definitely to look at.
Ryan, someone posted a question about the QBI and the 20% deduction and whether or not we feel like that's going to be around for 2021. In 2020, 18, 19, and 20, this new deduction came out called the Qualified Business Income Deduction that was a 20% deduction based on flow-through income from a trade or business. It could be a Schedule C, K1 from an S corporation, K1 from a partnership. And there was some limitations, there were some restrictions, et cetera. But basically, there was a 20% perhaps allowed deduction. If $100,000 came through on the K1, you got to take a $20,000 deduction. Only $80,000 of it gets taxed. This was put in kind of in conjunction when they reduced the rates from a flat 35%, from a 35% corporate rate down to the 21%, to kind of help those small businesses because there were so many flow-through businesses. So the question is, do we expect that we're going to see that 20% going into 2021? Biden, that is one of the things that was in Biden's proposals, as he was suggesting increasing the corporate rate, the C corporation rate, from 25 to 28%. That he also discussed taking away the 20% deduction. Brian, you have any thoughts on what you think will happen there?
They're also talking about increasing the maximum individual rate. And as you said, that was put in order to, when they cut the corporate rate so low, the individual rate stayed high, and so small business people were having a whole lot higher tax rate than C corps, and so that was part of the reason behind that. If they increase that maximum individual rate back up to 39.6, it seems like you're sort of giving a double hit to the small businesses if you remove the 20%, because you're increasing both the individual rate and eliminating the 20% deduction. And I think my own feeling is that's something that probably stays there, but because there's still going to be a much lower corporate rate than individual rate, but that you'll just see that the corporate rate goes higher and the individual rate is higher. But that's pure speculation at this point, as is just about all tax policy. But Congress is going to have to negotiate something through both houses and the administration, and I suspect what we end up seeing is not really going to look like what got talked about on the campaign trail. But there's just no way to know.
Yeah, my gut feeling is, again, it is speculation, is that for 2021, that we may see some tweaking, but I don't think I'm hoping that we don't see any major significant changes that are made in the 2021 year. And if so, hopefully they're not retroactive. And so we're all hoping that we still have the 20% deduction. We're all hoping that we're going to have the capital gains at 15 and 20%. And going back to your comment, Brian, on the flow through on the 39.6, that's was supposedly there only if your income's over $1 million. So those folks that were below that get the 20% deduction, and they're only in a 24% tax bracket, then they're well below the corporate rate. But we don't know. We just don't know. And getting something through Congress now, they haven't been particularly bipartisan on much. I hope they will be on the stimulus, this new stimulus package, and we'll get that carried through. And hopefully that PPP loan fix will get made in this. That's all our hopes.
Yeah, the PPP loan fix is probably the biggest thing right now that has the most significant impact to most of our client base, or at least the business clients. But but it does look like that's got some good momentum. Property taxes is another thing to think about. As most of you probably know, there's a $10,000 cap on state and local taxes now, and that includes sales tax, includes property taxes. And so if you're in a situation where you paid your property taxes in January of this year, you probably want to be sure to not pay them this year, because when you add on the sales tax deduction that you're given, that's usually $2,000 to $3,000, plus whatever property taxes you might have paid in January of this year, you're probably pushing up or well past your $10,000 cap. So pushing them in next year is a good thing. There have actually been some bills introduced to restore the full deduction for state and local taxes. And so if you defer your state and local tax deduction into to 2021, you may be the beneficiary of legislation that changes and adds that back. That was removed in the 2017 Act. There was a lot of politics involved, but New York, New Jersey, and California are the highest tax rate states. They're also big Democratic states. And part of the politics that went into all of that was to have the bill hit in California, New York, and New Jersey harder than it hit in some other places. And so there's a big Democratic move to put that back. Now that they've got some power, they're talking about restoring that. And so all that's to say, taxes that you can move into next year, you have a better shot at making them deductible than this year.
Question, Brian, that had come through earlier, that relates to itemized deductions, where we're talking about that. We still have the higher standard deduction that basically doubled beginning in 18 from where it was. And so it's continued to go up a little bit every year for inflation. And so the question had arisen, just how can we be most beneficial, most tax beneficial with regards to planning those itemized deductions? Many of us, we would used to bunch deductions every other year if you were not where you're going to be above the old standard deduction, and we got benefit of that big time on taxes that we doubled every other year, and donations we doubled every other year. When the standard deduction doubled, then fewer and fewer folks benefited from the bunching of deductions, what we call bunching of deductions. And then questions came up with regards to the mortgage interest. And so now perhaps your real estate taxes being maxed at $10,000, you have a mortgage, you've paid it down, and so the mortgage interest is only about $5,000, and so you're at 15, and you typically make $10,000 of donations a year. Basically what happens is the standard deduction is right there at that amount, and so you're really getting no benefit for the real estate taxes, and you're getting no benefit for the mortgage interest nor for the donations. And so what are the ways that we can be more tax advantageous in doing that? Should we just, if we have the ability, should we go ahead and pay off the mortgage and not incur that interest? Because now it's not a deduction that's being partially offset with tax benefits. And I think there is perhaps some wisdom in that. If it looks like if your donations typically are going to be, in my example, in that $5,000 to $10,000 range, and we're never going to be above the standard deduction, then some wisdom might say that could be a good opportunity. Obviously, you're making your alternative rate of return as whatever your mortgage rate is, basically, and doing that, you're taking it out of the market to pay. And so you've got to look at what you think you're going to make in the market as opposed to what that interest rate is. But we are seeing in that planning opportunity, we didn't talk about this when we were talking about IRAs, you have the QCDs, the ability to make donations directly from your IRAs. And for those folks that are using the standard deduction, basically they get 100% deduction by doing that. And that was a benefit before even 18, but it's even a bigger benefit, now when the standard deduction got doubled. So fewer and fewer folks, about 10% of the folks itemize, most are not anymore. And so the use of the QCDs on the IRAs is still very beneficial And I would suggest in most instances, unless you're making significant donations, of $20,000 or more, the QCD is probably the better route for making those donations. And particularly in this year, when you can pass on your RMD and not take that, you could still, if you so desired and wanted donations, the QCD route is still a valid route for making those, and having no taxation and basically getting 100% deduction for doing it through your IRA. Any other comments on that, Brian?
No, I think that's good. I would agree with all of that. I will say one thing to keep in mind on donation planning. This is there is a change this year to increasing the limits on how much you can donate to. Normally it's limited to 60% of adjusted gross income. This year you can actually go to 100% of adjusted gross income. That's not going to affect a lot of people, but big donors, it is a big deal. And also the other thing you can do a little bit of planning with, even if you're not itemizing, if you do donations with appreciated stocks, you can take a deduction for the full value of the stock that you give without paying the tax on the gain. And so even though you may not get the benefit of a tax deduction, you can still use the donations to eliminate the capital gain that's on in a highly appreciated security position. We did have a question on what is a QCD. It's qualified charitable distribution. Kraig was talking about those. Rather than taking a distribution from your IRA, it's taxable, and making a donation to charity that you're not going to get the benefit for because you're not itemizing or you're not getting full benefit for. You just have the money go straight from the IRA to the charity. And so while you don't get a deduction, you also don't pick up the IRA distribution as income. And so it's like getting a deduction because you're excluding the gross income. There was also a question on do we think tax software is going to help facilitate the required basis statements? The major softwares already do that. You're able to put those basis schedules in the return that you're e-filing. So it helps from that standpoint. Now, and if you have a good opening basis number, most of them do a good job of adjusting the basis schedule for the current year activity. The hard part is going back and digging out all the prior year activity. And I don't know any software that will do that for you. You've got to dig it out yourself and at least bring it up to date through the beginning of the year. And then the major softwares are then good at making the appropriate current year adjustments if you give it enough data.
You have to remember in the software itself with regards to like loan paybacks that go in the S corporation, it's not coming anywhere off the K1 typically. And so you're having to get that information, enter that in the system. But Brian's point is that the current data that goes in there, the tax software handles that pretty well with regards to the basis adjustments. But it's that number that you start with that perhaps we've been lax with for years and years and years. And so it's not a correct number and you've got to get that correct. And then on a go forward basis, tax software will do a pretty good job for you with some nominal things that you've got to put in there just in case.
So there's a lot of stuff to think about on income tax planning this year. There is also a lot of stuff to think about on estate tax planning. We don't have a lot of time yet, but I did want to make a quick pass through some of this. You know, the individual exemptions, the estate tax exemptions are very high right now. $11,580,000 per spouse. It's over 23 million for a couple. Those will go down back. They'll go back to 5 million per spouse after 2025. Biden has talked about dropping it to 3.5. And so there are a lot of people that are looking at making some large gifts here toward year end. While we know we have the high estate tax exemption, we don't know what it'll be in the future. And so in order to be sure that they get to take advantage of that, a lot of people are making these gifts right now. There are a lot of opportunities for estate planning that are driven off of the really low interest rates we have right now. You can do some things with intrafamily loans. Right now, the rate that you have to charge, for example, if you made a loan to family members that's 3 years or less, it's about 0.13% interest that you have to charge. You can pass money you loan money to family members that they can invest while paying next to no interest. There are some things you can do with certain types of trusts that are they're called grantor trusts, defective grantor trusts, where you can sell property to these and get them out of your estate and pay almost no interest on the loan. The trust can basically, you can sell or finance the sale of an asset to the trust, and the interest rate can be close to zero. Some of these trusts can actually be set up in a way where the donor, the creator of the trust, still has the possibility of accessing some of the money in certain situations. So it's, out of your estate, but there's potentially ways to still get to some of the money if needed. So these are important things, and there's a lot of planning you can still do with those. As well as, obviously the usual $15,000 annual exclusions you can do on gifts. In addition to that, you're allowed to pay for education for essentially anybody that you might be otherwise making a gift to. You can pay for private school tuition, college tuition, and those are in addition to the $15,000 annual exclusion. Those don't count toward your lifetime exemption, and so those are useful tools as well.
Medical expenses as well, if you want to pay the medical expenses directly.
There was a question relating to if we have donation left over from a carryover, can we write that off against AGI? If you have a charitable contribution carryover from a prior year to the current year, that's still subject to the same limitation it was in the past. That doesn't count toward the 100% of adjusted gross income limit that there is this year. I'm not positive that was the question, but that's the 100% limit only applies to current year gifts of cash to public charities that are not donor advised funds.
A couple of very smaller ticket items that we haven't covered. I'd like to go very quickly. The unemployment benefits that were this year, that those folks that didn't have the jobs, they got that extra $600 a week. Typically, there's no income tax withheld from that, but those are taxable. So those folks that had higher unemployment income this year may find that they owe some taxes come April the 15th on that income. I get questions all the time on the $1,200 stimulus. They didn't get their stimulus. What's going to happen with that? Those were basically prepayments that we got this last year towards the credit to be taken on the 2020 tax return. So in 2020, those will be calculated. If you've got a prepayment, it'll get reduced by that amount. If it shows that you weren't entitled to it based on 2020, but you did already get your prepayment because they used 18 or 19, you get to keep it. You don't have to pay it back. So it's a good windfall for you, but you don't lose out on it. It will look at 2020, determine whether or not you're eligible for it. And if so, then you're going to get your credit for both yourself, your spouse, and your kids.
It'll just be a part of this year's tax return.
Correct. The charitable donations, I made the big deal about this $300 above the line. So even if you use the standard deduction, you're going to get to claim a $300 charity donation this year if you made that much in donations this year, cash donations. But it was a pretty big change on the corporation, on C corporations, that was a 10% limit. It's now a 25% limit for this year. So that'll be, some of the C corporations get a little bit of benefit from that. One other item, payroll tax credits. I've had numerous clients that I've talked to in the last couple of months that weren't taking advantage of those credits. These are tax credits are given when you have employees that were out due to COVID, or their spouse was, and they had to be quarantined, or a child, or they had a child that was being quarantined, they had to stay home. If it was due to COVID, then you were still making payroll to them. Up to 2 weeks can be claimed as a 100% tax credit on your payroll tax form. So don't leave that on the table. That could be $1,000, $2,000 per employee for that number of times that they were out. So it's based on their payroll, but those add up if there's more than one or two pretty quickly. So get with your payroll folks and make sure you get those credits. Anything else in the last minute, Brian, that you'd like to cover before we close up?
I think that's about all I was going to cover today. We appreciate all of y'all tuning in, and I hope this was a useful discussion. Some of this is the same stuff we talk about every year, and then obviously some of it is brand new and special for just this year. And so, but it is going to be a harder year to do your planning, or at least for a lot of people it is, and a lot of stuff to think through. And I hope this was helpful.
Thanks for joining us.
Last thing, Kelly was asking, if the business got the PPP, the payroll credits were disallowed. Is that?
No, this is a different payroll tax credit we're talking about here. That was not the one where you were doing the voluntary deferral of the payroll taxes. So this one you still get even if you got PPP loans.
Great. Okay. All right.
Right.
Thanks, everybody. And if you've got other questions, you can follow up with your tax advisor, and we'll be happy to try to answer any questions anybody might have as well. So y'all have a good afternoon.
Thank you.